Hi everyone, I'm going to be recording my weekly market update on the SoundCloud podcast channel or on the YouTube channel this weekend. Stocks are crashing the market, they're leading the way down. That's what we've noticed for the last entire week, and I think it probably started Friday itself. And so we've had 6 to 7 days of negative closes on the broader indices, with the breadth or the advanced decline ratio actually turning in negative. So I'm recording this for the 27th of Feb over the Republic Day weekend, and a lot of enthusiasm around that. I think some good releases on the historical stories around it, but as far as the sentiment is concerned from the market front, I think by the end of the week we are seeing significant weakening happening, but there's a lot of hope still around based on what social media posts I keep seeing. And the reason for that is, and there's a big change from where we were maybe in the early part of December. When we hit 10,940 for the first time, we've actually hit that level again and again, I think 3 to 4 times, making slightly higher highs. And I thought the last one we did in late December was done with, but we again did it this week, touching just the 10,985 mark, making a slight higher high once again, but not really crossing the 11,000 mark. So I think that's what ended up happening, and then we closed the week down because of the poor breadth. So the broad market has started to pull the index down, and I think that's a trend that's likely to continue. And I think I've been seeing that for a while. It's taken the entire month out. That I think was not expected, because we started this counter trend move in early November or late October after we made that low. And then we've been bouncing back ever since. And so after almost 2 months of bouncing back, I thought probably this month you'd see the roller, you'd probably make that high near 11,000 or higher in the early part of Jan and then roll over. But instead, the early part of Jan, we just remained below those levels and only ticked up to make that minor high, making Jan the higher high than December in the third week of January. So in that sense, we ended up buying even more time, so that pushes us into the third month in which we've had a counter trend bounce going on and not completing, but probably I think rolling over. And this trend is very similar to what we've seen, I think, 2 times prior. The last year, 1 year ago, the mid-cap indices peaked in the first week of January, I think by the 9th or 10th, and then the Nifty continued higher to make its final high on the 29th of January. We saw the same thing happen even in 2013. That's the year in which the rupee had gone to 69. But of course, it did that only in July, August. But in Jan of that year, the mid-cap indices peaked and started to sell off from, I think, the 4th of Jan itself. But the Nifty held on as, results were coming out, and then you had Reliance and Infi. I think either one of the result days managed to make that final peak high on 29th of Jan, or it was the interest rate decision, or a combination of those that, completed the topping process. And then after the 29th of Jan, we rolled over. However, the last few years, the end of Jan has become a turn date, not because of the change in history since 2013, but also because we started to present the budget early than what we used to do before. And it was my sense that, when they changed the budget date a couple of years ago, that they've probably done that keeping this particular election in mind. And everybody kept telling me, no, that's not the case. It's probably been, when it comes to an election year, it's always going to be a vote on account, because that's the precedence or that's a rule. But really, there's no rule. The only rule is that, a certain time prior to elections, the election commissioner has a cutoff date before which you can't really take any, policy decisions. And I just thought that by pushing this date backwards, it would allow them to present a full budget. And now we're pretty close to almost seeing that that's what is likely to happen. Although, it's being said that, it's going to be a normal budget, or at least it will take care of, things from now, but it's not going to be a vote on account. So that calls for, creating a lot of room for some volatility around the budget date, which is going to be Friday this week. and so it's a very important week from a pure vol point of view. But you have a lot of news events now, apart from, mostly from the results front. A lot of poor results that were expected are starting to flow in. You have the PSU bank results also coming in, where expectations were that things would normalize. Maybe you'll see some of it, but I don't think it's likely to be across the board. But that said, we also head into the Fed meet, and one of the reasons why you saw the dollar pull back, even though I was expecting it to continue higher, I think is ahead of the Fed. People are beginning to price in the potential for the announcement of a rollback in the interest rate policy. And I don't think things will move that fast, though that's what eventually will happen as the economy slow down. And the slowdown has been a full 1 year round process, starting from Europe, Asia to the US, and now I think Indian numbers, some of them are starting to weaken. But US and India were probably the last in terms of showing a weakening cycle as far as the economic data is concerned, the macro data in terms of growth. But now that's becoming more and more visible, markets start to recognize that, though we've seen a bounce back from an extreme oversold situation late of December, once all the news was out of the US, apart from the Fed rate hike, also the shutdown that the US has been facing. I think once that news was out, in a couple of days, the US market bottomed and started to bounce back. And that's typical because most news-based events, usually you get a reaction within a day or two, and then it starts to bounce back. Now, while I was expecting that bounce, I didn't expect it to become this big, because if you're looking only for a fourth wave, you weren't really looking for an overlap with the low that you actually made in October. But now you're well above that low, and so it calls for a change in wave count. And while it does that, we go back into the debate as far as what the long-term structure is, and whether you're still in a long-term decline, or this was just a correction and now you're headed back to new highs. But increasingly, the amount of, apart from the technical readings, as I also look at, what all the research is showing, none of the growth data is really going to be changing as far as the US is concerned. In fact, earnings growth, which was in double digits, 23% almost, I think till September, is likely to slow to it's going to be less than 20% for this quarter, and then eventually in the next 2 quarters it's likely to be in single digits for the S&P 500 is the data that I am seeing, based on that has been published by the work that I read, the research work that I read. So those are the numbers, and so that slowing would really not provide the upside news, and so it purely comes down to looking at sentiment. Now, sentimentally, it looked like the entire structure from 2009 to 2018 is a 5-wave advance, and this sell-off should have been the start of something. The only thing is that when we start a bear market, we start looking for larger degree 5s, but that doesn't always end up being the case. In fact, larger degree bear markets can more often than not end up being complex. Even if I look at India, 2000 to 2001, 18 months bear market, from the tech bubble to the bottom, was a complex structure. WXY, XZ is what a complex structure is, wherein each sell-off is 3 waves, counter trend is 3 waves, then sell-off is 3 waves. So at this stage, we don't know whether the US will form a complex structure. In fact, 2000 also, the US, the Dow actually formed a complex structure. EWI, or Elliott Wave International, kept calling it a series of 1-2s, because that's the time around where Petter was calling for that final high of ending a long-term fifth, and then he started marking impulsively, and he kept on doing that till the US market bottomed and then turned around. But my markings throughout that time period, which I was posting to whoever was reading the Indiacharts blog at that time, was that it's a series of 3 waves or corrective patterns, which I ended up marking as WXYZ. The only difference is that India bottomed in September of 2001, right after 9/11, whereas the US market continued to decline for almost 6 to 8 months later, or 9 months later, into 2002, right after the Iraq wars had already started, and then they actually got their turnaround much later. So there was that long lead lag effect between the two markets, which you get at major turning points. And so the lead lag effects that we've really seen across global equities, to me, is part of that process where you're actually getting the topping between various markets, which is why each one is occurring at a different point of time. And as the emotions pick up, my sense is eventually you'll align. I thought that would have started to happen from December. It didn't. Even now, it looks like many Asian markets that have really not fallen when the US sold off. In fact, India has not reacted even as much as Asian markets. They at least tried to reach a double bottom in this sell-off and then bounced back in a larger degree, wave C of a counter trend move. So they at least did that much. India didn't even go that far down. It just reacted once in December. Then after that, we've been more or less flat, both to the downside and to the upside. So even as the US bounced back and rallied over the last month, we've really not seen the Indian markets move. So we've really gone into a no trade, no volatility, narrow range, not going anywhere. But the last week, like I said, in fact, the mid-cap index has actually peaked in the third week of December. They haven't really gone higher than that. They've made lower lows and continued to break down. It's only the Nifty that held on the back of a couple of stocks. And so that's another divergence that continued to indicate that the upside will be limited. And once you get the rollover, it's likely to be a broad-based decline. So we are seeing a broad-based decline. You're seeing stock sell-off. You're seeing some of the large caps give up. It's just a few, I think, that have not yet done so. Reliance continued to sneak up a slight mild new high for the month, even on Friday. And so while that's happening, I think we are still looking for those last one or two stocks to turn lower and confirm what is already happening, I think, in most other sectors. But the loudest one is, I think, the auto sector. I'm probably naming that a third time in this video because that was one of the lead sectors on the way up. It continued to outperform with the banking and NBFC space, and now it's actually rolling over. In fact, NBFCs, the other space, is also showing a slowdown in earnings and numbers. You just saw DHFL, which was caught up in a lot of trouble earlier, show no growth in loans and disbursements, and that might happen in a couple of other cases because of what happened post the ILFS case, where a lot of lending and borrowing actually slowed down. And while we've tried to stabilize the situation by actually providing a lot of money to the NBFCs through the banking sector, which means banks have actually lent a lot of money, outsized amount of money to the non-banking sector. Their loan growth might really not have picked up that significantly, which is what we continue to look at in these results. So you're seeing weakness in that space, especially. So if you see housing, for example, you only see HDFC Bank holding on closer to the highs, but all the other housing finance companies have been actually falling, and so they have actually been showing a lead as to what is happening within the sector, and similar signs you see also in other non-banking areas, and that's likely to be a concern. So with this narrowness, I think stay prepared for further weakness in the Nifty. If you've not seen volatility come back, I think volatility comes back once these events are through. All the expectations from the budget will be done. Will it be populist or not? I mean, the likelihood of it actually being so are relatively high, given the upcoming elections are a big fight now, and you really want to sound out to everybody. There are also hopes that there will be a lot of tax giveaways. Particularly, someone actually sounded out to me, why would they not do away with maybe LTCG or so? But the thing is, the government can't really give away too many taxes, especially if it's intending to spend on social and other broad-based areas where it wants to get the populist vote. So you can't really do away with non-populist taxes. So that expectation might not really be well-based, and therefore I think what we might be looking at is potentially higher expenditure, and that means the bond yields would continue to remain under pressure, and the currency continues to remain under pressure, a trend that we've already seen develop in the last few weeks based on exactly that expectation that the government would borrow more and that there could be a weakness in the currency. But part of the reason the currency weakened was also that the dollar turned. I was expecting that after having given up my immediate bearish view for the dollar that I took in December. My sense was that the sell-off might not continue immediately. It might come back at a later date. Not looking really for new highs on the dollar index, but on a long-term basis, but on a short to medium-term basis, looking for it to turn around is what I was thinking. And we got that turn. It pushed up the USD INR as well. But this week we've actually seen the DXY give up some of those gains, I think, essentially because we are ahead of the Fed meeting this week, and expectations from the Fed have changed after a lot of comments that Powell made. But I think once he's actually made his speech, it will become more clear by the end of this week that what's likely to be the future course. Is he going to continue on the course that he's already outlined in December, and the rest of the talk is essentially soothing statements for the markets or whether there's going to be an actual change in his policy stance. I think you'll know by Friday along with the budget, and I think that will then set the tone for markets from there on. But just if you look at history, once you go into a rate hiking cycle on the back of growth, you don't really go into a rate cutting cycle immediately. And even if you do, it's a process. You don't go from 2% to 0. You go from 2, then you cut it, by 25 basis points, then another 25 basis points. And if you keep doing that, by the time you reach a point where it is stimulative to the economy, you can actually be 1 to 2 years down the line, which is what happened both in 2000 to 2001 and also from 2007 to 2008. All through that while you had the Fed change its policy from tightening to loosening up. It started to cut interest rates. The markets may have rallied in the short term, but eventually continued to fall till enough cuts had been done that can become stimulative in nature. That's also been true for the Indian market. If you go back to 2015, go back to 2012, all these time periods when the RBI was cutting interest rates, the stock market continued to fall, topping on many times the tops were made on the date that the rate cut was actually announced. You can go back and check, and that's what ends up happening. It took around 3 to 4 rate cuts all through a 12-month period before you actually got a bottom in late 2012 and late 2015 and early 2016 on budget day. So that's the trend. And so I think once again, if you do move into a rate cutting cycle, it will be, it's not likely to be something that the markets will feed into immediately, simply because the slowdown has already started to happen, and the economic slowdown will not turn till you reach a point where it gets stimulative enough. And in the meantime, in the interim, I think we have too many issues to worry about apart from our own elections. All the geopolitics that's been going around in the US, I think we are likely to continue to witness though, and the trade related issues that are still ongoing. So you're going to witness a lot of that still play out in the weeks and months ahead. And of course, the quantitative tightening, which is not yet going to stop. So even if you get into a rate cutting cycle for the US, you're still going to be unwinding your balance sheet. So none of those pressure points are going to change. And so it just comes down to one thing, is to look at your own market. And right now, even though the US did make a new high on Friday, our own market has been doing its own thing in terms of selling off and rolling over at a stock level and eventually pulling down the Nifty. And those lead lags were similar to what we saw even in the month of September, where Indian markets peaked at the start of September, but the US only did so a month later at the start of October. And till that point of time, even Asian markets were actually holding up. And that's what you're seeing even right now. So just because there's that lead lag happening between these markets doesn't mean that our own market will continue to hold good just because Asia and the US are doing so. So with that, let me wind up long, rounding quick talk around what all is happening. I'm of course going to be speaking next week at the Traders Carnival. I've already announced that, and they've been posting it as well. So that there I'm going to be discussing not just the market view and view on various asset classes, especially the long-term wave counts, where I can use a lot of data, 50 to 100 years of data on whether it's currency, gold, and equities. Look at that, but also put it in conjunction with what I've been writing about for many, many years, is India's long wave cycle, the quantitized cycle, and where we are, which is the economic winter, and how it pans out. What are the key factors that play important role in this stage of the cycle and in all these stages of the cycle. So try to go over the entire cycle, various stages, and explain them, and then put it in context of where India really is right now and what you expect in many of those aspects going forward. So you know what macro factors to really watch, so that you know where you are in the next stage of the cycle. So that's all from me this week. Thank you.